Hi, everyone. Fantastic. I think we're live now, and um, let's see. Awesome. So thank you, everybody, for making it to today's panel conversation, latest trends in negotiating early stage VC term sheets. We have a fantastic panel here with you. My name is Andy Saldana. I'm the Executive Director of New York Tech Alliance. I have a few quick thank yous and announcements, and then we'll get right into the panel conversation. Let's see. So a little bit about New York Tech Alliance. We are a nonprofit organization here in New York City, driving access, equity, and inclusion in the New York tech community and make it the most diverse and dynamic in the world. To learn more about us, please check us out at nytech.org. And you can see my email here, andy@nytech.org. I'm always here to help, so please feel free to reach out. A quick privacy statement: we are live streaming and recording this event. So if you do have a question and we do bring you on stage for whatever reason, just please note that you will be on your image and your audio will be recorded. If you prefer not, just put your questions in the Q&A and we will ask them from the Q&A module. A few quick thank you to all of our amazing annual partners that make all of the programming that we do possible. Everybody from Crown Castle, Eisner Amber, who's on our panel today, Paul, who's moderating our panel, Propeller, Xander, SoftServe. They're all amazing service provider doing great things in the community. Insperity is one of our newest partners, and they're all here to support the innovation community, and we encourage you to check them out. You can always find their information on our website at nytech.org/partners. And then we have we have 3 more events before the end of the year. We've been very busy this year, and we're going to end the year off with a great roster of events. The next one is on Tuesday, November the 23rd. It's a conversation with the founder, Tanya Van Court from Goalsetter. We do about a 45-minute conversation learning about how she's built Goalsetter, the decisions that she's made in building the company and scaling the company. So join us on November 23rd at noon. They're always fantastic conversations. Then on Tuesday, December 7th, we will have our last meetup of 2021. It's our December New York Tech meetup, and it's a celebration of women in tech, women's demo night. We have 3 amazing founders that will be showcasing their technologies to the audience. Everything from real estate and prop tech to disability accessibility tech for dyslexic children. So it's a broad range, different types of products, and it's all about the tech. So we hope that you can join us on Tuesday, December 7th at 5:30. And then on this Tuesday, December 15th, we end the year with another founder spotlights with Fanta Gilliam, founder of Wealthy. She demoed at the October meetup. She's an amazing founder, a great product. And again, we'll be diving into how she built Wealthy and why she's made the decisions she's made in building the company. So join us for all 3 of those events. You can always find them out on our website at nytech.org. And then if you like what we do and you want to support us, we ask that you make a small donation when you RSVP for any of our virtual events, that you become an individual or corporate partner of New York Tech Alliance, or you can simply make a small donation on our website. You can find all of that information on our website. And then lastly, we have produced some amazing content this year. We ask that you subscribe to our YouTube channel, and you can find all of our amazing content videos, including the additional videos from this series, the New York Tech Alliance forums, on our YouTube channel at youtube.com/New York Tech Alliance. And with that, I'm going to turn it over to the amazing panel. Paul Ellis, the moderator, the leader, one of our amazing board members. Paul, why don't you take it away?
All right, Andy, thank you very much. And again, welcome all to our attendees. Looks like we have a great turnout. We actually had over 200 people registered and a lot here. So it's an important and timely topic, obviously a lot of interest. So we are going to jump right in. So again, as Andy noted, I am a board member at Tech Alliance. I also run this series of events on legal issues and financing issues for startup companies. This one is a topic that we come back and touch on from different directions, in different ways. At this point, it's really timely given what's going on in the market. So we're really looking forward to today's panel. We do have a great roster here with us today. We have Aaron Holiday of 645 Ventures, Robin Lee of GGV Capital, and Alan Wink of Eisner Amper. So before we jump into substance, we're just going to go around the screen and each introduce ourselves briefly, and then we will jump right in. So again, my name is Paul Ellis. In my day job, I'm the managing partner of Paul Ellis Law Group. We are a 9-person boutique firm in Midtown Manhattan. We do a lot of work with tech and tech-enabled startup companies. Our clients are looking to us to come up with creative, cost-effective solutions for their legal needs so they can focus on building and growing their companies. Beyond the sorts of financing activities we're talking about today, whether it's venture capital, angel, or friends and family, we really cover the life cycle of issues for startup companies. We do IP protection, employment agreements, equity plans, general operational matters, and M&A and other types of exits. All of our attorneys come out of top law schools and major firms, so we're able to offer big firm expertise with the more reasonable cost structure and personalized attention of a boutique. I should mention that later this afternoon and early next week, I'll be offering office hours. So if we don't get to your question today, or if you'd like to talk offline, there will be a Calendly link we will put in the chat. Feel free to set up a time to talk with me at a later point. With that, I will turn it over to Aaron Holiday.
Yeah, thank you so much for the opportunity to join. I'm excited to have this conversation. It's something that is kind of an active conversation and a live conversation happening in our business. I'm the founder of 645 Ventures, which is an early stage venture capital fund that leads Series A rounds, that also leads seed rounds. We have 2 offices, New York and San Francisco. We've been around for 7 years. We have 3 unicorns in a portfolio now that we backed at the earliest stages. So for instance, the seed stage, and several other companies that are kind of approaching 100 million in revenues and that are kind of on the verge of going public. So we focus on enterprise SaaS, infrastructure software primarily, and occasionally we'll make investments in consumer companies when there's deep technology under the hood.
Aaron, great, thanks, and really, really pleased to have you. Robin?
Hi, everyone. I'm Robin Lee. Good to meet you all. I'm based here in New York, so dialing in from actually Chief, one of our portfolio companies. I'm in Flatiron right now. We are a global venture capital firm. We've been around for over 2 decades, have primarily invested in 3 different sectors. 1 is consumer internet, 2 is smart tech, and 3 is enterprise. And I focus primarily on consumer and smart tech here in New York. And we also do a lot in seed to pre-IPO, so we're really stage agnostic. We're currently investing out of our 8th fund, which is a $2.5 billion fund. So we have a lot of dry powder and actively investing in New York. We have over 45 portfolio companies here and want to do more. So looking forward to the conversation today, and thank you for having me and GGB here.
Great, Robin, really, really pleased to have you. Alan?
Good afternoon, everyone. Paul, once again, thanks for inviting me to participate on this panel. Looks like you've assembled, once again, a great panel. My name is Alan Wink. I'm the Managing Director of Capital Markets for Eisner Amper. We're a global accounting and advisory firm with offices across the United States and 6 international offices. I was one of the partners who founded our tech practice about 18 or 19 years ago. I do a lot of work in the tech space with clients in all areas of the life cycle for tech and life sciences companies. And I look forward to participating in the discussion this afternoon, and would also be available for office hours after this panel discussion.
All right, very good, Alan. Thanks to have you as always. You're one of my stalwart panel attendees, so really great to have you back. All right, so we can jump into content. Andy, we can get the first slide. So those of you who are veterans of my events know that we always pack them full of content, a good slide deck, and we want to make sure you're getting your money's worth, and today will be no exception. We've got a lot to cover. So what are we doing today? We are going to start with a market update. I don't need to tell you, it is going like crazy out there. Everyone, the panel knows, the attendees know, and so we'll be talking about that. We're going to talk about preliminary considerations for VC negotiations, general concepts or important factors to keep in mind. Typical early stage investment instruments, convertible notes, safes, preferred stock. Talk about those briefly. We will go into term sheet fundamentals, some basic concepts around term sheets, and then we're going to focus more on current trends in negotiating term sheets. What's happening in the marketplace now? What are our panelists seeing? Things that you all need to keep in mind. We are going to do a deeper dive on preferred stock, how it works, since that's really our focus today. And then we will pick up on several of the most important preferred stock terms, so we can see how those are impacted by the current marketplace. And then we'll put up a list of everything else, the other terms, although things we're not really going to be speaking about today. So that's what we're covering. What we are not going to be covering today, I should say, again, for those who are veterans, this is part of a series that we have occasional topics on VC financing, approaching the topic from different directions to bring out different aspects, different important issues. So some of the things we won't be touching on today is, what are the alternatives to VC financing, bootstrapping and other strategies. We're not going to be talking about costs and benefits of VC financing, because people probably appreciate while there is a lot to be gained from VC financing, it does come at a cost. We're not going to be talking about angel financing, which is something we've talked about in the past, the differences between angel and VC, pluses and minuses. We won't be going deeply into safes and convertible notes. That's obviously how a lot of early stage deals are getting done, but the negotiation issues are different and less complex, I would say, than preferred stock. And securities laws. We will not be speaking about those today, but I urge you to speak with your lawyer. Now, I will say that, as I mentioned, we have these topics we've touched on before. On this slide, we have 3 events we've had over the last year and a half, 2 years on venture capital financing. These sessions are available by video on the Tech Alliance YouTube channel, as well as on the resources page of my law firm website. So I urge you to go take a look at them if you're interested in some of these other topics. Next slide, please. So I should say a little bit about process. We're going to be doing Q&A a little bit as we go. We might do a little bit at the end as well. So feel free to put your questions into the chat, the Q&A function, and we will get to as many of them as we can. I will say that with the number of attendees, if there are a lot of questions, we probably aren't going to get to everything. I also have some questions that came up earlier on, so we will certainly get to what we can as we go along, but I'll probably have to focus on the questions that are a little bit more generally applicable and that are sort of very much within the scope of today's topic. So goals. No surprise that VC finance is a somewhat complex and arcane topic, and frankly, unless you've been through it a couple times, it can be difficult to understand exactly how to maneuver your way through. So part of our goal today is to take you through it, to talk about issues and things you need to understand that will give you a leg up as you come into your first VC deal. We can't give you all the answers, but we will at least try to get to the questions and the issues, sensitize you to what you need to know and understand, again, so you're a little bit further along the process. We are going to try to address some of the fundamental issues, but also spend some time talking about the latest trends. What does the panel see happening in the marketplace right now that you all should be aware of? With that, we will turn, excuse me, we'll turn to our market update, and I will turn it over to Alan Wink.
Thanks, Paul. And I'm pretty sure my co-panelists who are investing in today's market will agree with my comments here. It is a really frothy market for investment, and it's a great time to be an entrepreneur or founder looking to raise capital for his or her company. It's been an incredible year. Even with the pandemic, the last 2 years have been incredible times for venture capital investment. Records are falling every quarter. If you look at the last 9 months, through September 30th of 2021, we're already breaking records that were set on 12-month periods of time. The last 9 months, we've seen almost 239 billion of VC investment. The old record was 166 billion. We've seen venture capital exit values at 583 billion. The prior record was 289 billion. And really about a little less than 90% of those exit values were due to public company transactions and SPACs. We've seen venture capitalists raise $96 billion for the first 3 quarters of 2021. The old record was 85 billion. And 2021 will be the first year that new VC funds have raised $100 billion in the market. It's incredible. Mega deals over $100 million, 136.5 billion the first 9 months of the year. The prior record was under 77 billion for a full year period of time. So you're seeing incredible investment. The fact that fundraising is at record levels means that venture capitalists are going to have dry powder for several years into the future. So I anticipate, this type of activity continuing. This year so far, we've seen 221 IPOs completed, and year to date, SPACs have raised almost $110 billion. It really has, redefined the word frothy when you talk about venture capital. So it's an incredible time.
Alan, thank you for that. Robin, any additional thoughts or perspective you want to add to that?
Yeah, I would say that, we definitely feel it here as a multi-stage firm. Not only has there been like record investments and size of investments, but like the speed in between rounds have been faster than ever. So we've seen even like firms putting in money ahead of time, where like you just closed a Series A 3 months ago and you're already closing your Series B. And that is not typical as it was in the past, right? Like you usually have a year to year and a half of runway, and then you go out later on to go fundraise. But then now we're seeing a lot of companies and startups taking advantage of this and just building a war chest much earlier on. And so that has its goods and bads, right? From a firm perspective, actually, it is sometimes difficult because we have, pacing and also reserves that we set aside for companies, and like everyone is doing well. Like, how do you support every single portfolio company? And so there's a lot of like pros and cons in the market as well.
Understood. Aaron?
Yeah, I'm looking at the amount of capital that's being raised. I wonder if it takes into account hedge funds that are moving into the market, right? So I'm not sure if this is data just categorized for firms that are categorized as venture capital firms, or if this is also showcasing the amount of external capital that's moving into the private market. We're seeing a lot of it. So we're seeing a lot of Code2. We're seeing a lot of Tiger Global coming earlier. The last time we've seen something like this was in the early 2000s, right before the big kind of tech bubble. A lot of people who are in the market right now may not have been around during that time. My co-founder was just starting his career in venture capital during that moment. And at that time, you also saw hedge funds coming into private markets. The difference is we're seeing hedge funds come a lot earlier, which is also applying a lot of pressure on multi-stage firms to go earlier, because the hedge funds are what we're calling taking out the middle. So you're seeing companies jump from kind of a Series B almost to like a Series E type valuation. So we've seen companies go from close to $100 million post-money valuation to $1 billion in a period of time that's dramatically accelerated. One of the things that's interesting about this is these opportunities are not substantially de-risked. So we're on the boards of these companies, we're working closely with these founders, and we're seeing them accelerate to valuations that doesn't necessarily correlate to kind of where the business is. So the business is much, much further away from where the valuation is. So that's a little worrisome, but kind of as Alan mentioned, so there's so much capital in the ecosystem that it buys founders and investors a pretty substantial amount of time. And so it's unclear whether or not we're going to deal with this reckoning anytime soon, but it is definitely a meaningful change in the market and dynamics than what we've seen over the last several years of being in business.
Aaron, thank you for that. And there are some important themes and things we're going to be touching on a little bit more later. So let's go to the next slide, which is really by way of preliminary considerations, things to be thinking about when you enter into VC negotiations. First, at the outset, do not underestimate the amount of time and work required to get a deal closed. Although deals are moving faster, they still take time. They take time in terms of weeks and months at points, but also in terms of hours out of your day. So I think by way of advice that one gives, I give to my clients, make sure you are factoring in the amount of time to get your deal done, whatever the climate. The way it is now, things are moving faster, but it is a time-consuming process one way or another. Another important thing to think about as you embark on this process of negotiating a VC deal is that you should not be ignoring your business while you're getting your financing in place. And something that I, again, speak to my clients about, that can go wrong in a number of ways. It can be a problem with the deal in front of you, because if the VC sees that the fundamentals of the business are starting to weaken, that can create problems with the deal that you're working on. And God forbid the deal goes south, then you find that the business has been damaged in the process and is not moving as quickly as it was before. So you got to keep your eye on the business fundamentals at the same time as you're getting your deal done. Which brings us to the point, devote sufficient resources to the process. Ideally, you have a dedicated internal team. Again, I say to my clients, especially companies where you have multiple co-founders, to some extent, one or two of the co-founders can focus on getting the VC deal negotiated, and one or two can focus on running the business. Now, at the end of the day, probably all of you will have some involvement in everything, but to the extent there can be some focus, that does help to make sure that all of the fundamentals are being covered. When it comes to negotiations, don't be afraid to walk away from a bad deal. And frankly, you have to be ready to walk away from a bad deal. People will get emotionally attached to a deal. They feel as though they've put so much into it, they just want to get it done. They'll get deal fatigue, that they're so tired they start to give away deal points that they shouldn't, because they just want to get the deal done. Or another thing that comes up is you get so far down the road and the company starts to run out of cash, you get yourself into a position where you have no good alternative but to get that deal closed. And if that happens and the VC gets wind of it, that can weaken your negotiating position. Having multiple interested investors is always a plus, but don't overplay your hand. VC investors, if they feel as though they're really being played, different term sheets, that can put a chilling effect on getting a deal done. So it's a good problem to have multiple interested investors, but be a little bit mindful of how you play out that process. The last thing I'd say is, you as the founder, as the principal, you have to own the process of your VC deal. Parts of it can be handled by your lawyers, and the lawyers have an important role in the negotiations, but the critical business issues, you have to stay at the heart of them, make sure they're getting resolved in your interest in the way that you're looking for. With that, why don't I turn it over to Aaron? Aaron, any observations on that?
Yeah, one thing that you said I think is quite important, that I want to just kind of zero in on, is this idea that fundraising is not a success metric, right? Fundraising is not a major milestone in the business, and don't lose sight of that as founders. Use kind of the fundraising as a way to get kind of access to capital to kind of start building your business and start moving toward KPIs and OKRs. Sometimes what we find is, immediately following a fundraise, founders start to put their heads down and start building their business. And then they start thinking about fundraising again, because the market right now is a little bit easier to access capital. But the question is, how close are you to product market fit? Kind of, it's probably more valuable after you have raised capital to be building your product and trying to solve a problem that the customer base needs, and that is demanding. So that's the only point I would like to elaborate on, is don't think about fundraising as a success metric or a major milestone. Continue to stay focused on the business and solving the problem that the customers have.
Aaron, thank you for that. Robin, any thoughts?
Yeah, I think that's like really comprehensive advice, right? Because we see a lot of people keep being pulled back into the market and very distracted constantly, right? Because you just like, once something gets announced or people hear about it, you just like constantly get pinged. And VCs, have FOMO and want to be in the round. And so I think staying focused and building your product is really, really important, as Aaron had pointed out. The other piece I would say is to like try to get to know your investors before you just like suddenly start these negotiations or go down this path, because most of the time the lead will take a board seat, and you're going to be tied to them for a really long time. And so get to understand the firm, get to understand the person and their team, and also like other portfolio companies that they may have. Aaron had pointed out a lot of the hedge funds are moving into this space. Like I rarely ever see them take a board seat or want to take that board seat, and they prefer not to because of their public positions, right? And so like, how do you want to structure your syndicate and people around the table to help you? Because they're not going to dedicate a platform team, a talent team, or other support and be by your side. But they're excellent capital, right? And so something to think about as you're also building out the investors on your cap table, and how you want to think about negotiating a deal as well. It's not always about every single, the best deal you can find out there at a given moment in time. I think it's more about synergies and a partnership, just like a marriage.
I guess, as you're saying, Robin, there are a number of factors that come into that decision, especially when you have multiple potential investors. The amount of money they're going to put in and valuation are certainly critical, but what else are they going to bring to the table? Will they bring contacts? Will they bring relationships? Will they be there on your board? I mean, these are key value points that, as you and Aaron are both noting, a VC fund will bring. A hedge fund, maybe not so much. So that's very important points.
And do your diligence on your investor, right? Like we will call references and we'll do diligence on you as a founder and your founding team, but like you can do the same for your investors. And so as you're negotiating a deal, and we've seen this happen quite a bit, is like talk to other portfolio CEOs who's worked with that deal partner or that firm. And you can learn a lot that way as well.
Absolutely, Robin. That's really a critical point. Alan?
Just a couple of other points, Paul, and I agree with Robin's assessment about due diligence. It's important to do the same due diligence on an investor that an investor might do on you. But one of the important factors that I see with a lot of founders going out to the marketplace to raise VC money, understand how much money you really need and how that money is going to be deployed, because it's definitely going to come up in discussions with your VCs early on. How is the money going to be utilized? How much do you need? Where is it going to get you in terms of milestones? So that's what I would add at this point.
Absolutely. Absolutely. All right. Andy, we can go to the next slide. So very briefly, let's talk about the typical early stage investment instruments. What is it we are in fact negotiating? Well, generally speaking, convertible notes, safes, preferred stock, that's the instruments that get used in early stage deals. Back in the day, that is like 10 years ago, we saw a lot of convertible notes for smaller early stage deals, say 6-figure deals. Over that period, convertible notes have largely been supplanted by safes, simple agreement for future equity. I'm guessing most people are familiar with them. If you aren't, easy to learn more. You can go to the Y Combinator website. There's a lot of information there. They were created by Y Combinator and have very quickly become a typical instrument. Used to be for 6-figure deals. Then we started seeing them for 7-figure deals. And lately I've seen them for 8-figure deals, which is, I'd say, almost shocking that people doing an 8-figure deal without doing it as a priced round, but we are seeing that happen in the marketplace. But what we're going to be focusing on today is preferred stock. Now, that is actually stock. Convertible notes and safes are, convertible note is debt. Safe has some features of a convertible note, but it doesn't have a maturity date or an interest rate. It will have a valuation cap usually, and maybe a discount rate. But preferred stock is actually equity. And a little bit later, we will go deeper into the aspects of preferred stock, the things that need to be negotiated. I will say that preferred stock is to be distinguished from common stock. That is what founders get at the outset of the company. It's also what employees get either in restricted stock or through options, but it is not generally used for early stage investments. If anyone has anything to add to that, I'll just open it out. Alan?
I'm fine at this point, Paul.
Yeah, I'll jump in there. So I saw 2 weeks ago a company that had an offer for a $100 million kind of post-money cap safe. The company, it's the current stage of the company is a seed stage company, so it has not yet even raised a Series A. And so why are they seeing this? So as Robin mentioned, as rounds are being announced, investors are having FOMO, fear of missing out, and they want to get money into the deal by any means necessary, right? And so this was one tactic we've seen where, founders were offered a $100 million kind of post-money safe, maybe 30% discount, just to get $5 million into the company. And that sounds interesting to the founder, but in reality, when the price round happens, that round could easily be priced at half that valuation, because the safe note.
Hey, Aaron, when you say $100 million safe, I'm sorry to interrupt. You mean $100 million
post money
cap?
Yep, valuation cap.
Okay, got
post money cap.
Yep.
And so that tactic is really a way for the investor to just get money into the investment without having to price the round, but use the post money cap on the safe as a mechanism to show an attractive term. But in reality, when the company in real life raises a price round, that round may not be post 100 million, right? Like that round could easily be 35 million or 40 million when you have a actual lead that comes in. So I think the intention of the safes right now are kind of taken advantage of when you see investors who are using it as a way to just get into companies and to defer the actual valuing of the company.
And Paul, just to add something to what Aaron just said, and I agree, you know, there is a downside to taking in money at an extremely high valuation too early. And, you know, the downside is that, you know, if you have to go be subject to a down round at a point in the future, that's certainly not a good thing. So I think you have to be very careful with, you know, the valuations you get for your first couple of rounds of funding.
Alan, and Aaron, those are critical points. We'll be talking about them a little bit further. But yes, getting a high valuation is a good thing within limits, but it can bite you later on.
Yeah.
Robin,
and you guys are experts here, but the convertible note or the safe note is really not a firm valuation of the company. It's not like you're exchanging shares for a price, right? So it's kind of like an implied valuation, right?
Well, that's absolutely right. And Aaron, that's a very good point. That's a conversation I have with my clients all the time. They will conflate the cap on the safe with the valuation. Well, it's not. It just says, this is the highest that you will convert at, but it isn't a valuation. But in the eyes of founders, sometimes they'll think of it in that way. It's an important point. Robin, any thoughts?
Yeah, I think the only thing that I would add around convertible notes or safes is there, as a company, you probably only have one chance in between rounds to add something like this. And so what I mean is let's say you raised a seed and you're going to raise the next round as an A, but then you have a lot of inbound interest and people want to give you a certain valuation and you do a note. Well, it will look really bad on the company if you take multiple rounds of convertible notes. YC used to would push this all the time, especially in the early YC rounds. But it is something that you should take in account. How much dilution are you really getting each time as you're offering these safes, because they don't actually convert until your next round. And so be very careful as you're kind of thinking about, should I take this money? Should I do multiple notes? I think as an investor, we typically don't like it, or there's red flags when we see a company who, is now going out to raise their Series B, but before that has had maybe 2-3 convertible notes in between, because that's generally a sign of well, why didn't you just get a lead to price your round? And raise that money. And so it's usually not that positive.
Absolutely agreed, Robin. Agreed. Let's go on to talk about some fundamental issues with term sheets. We're focusing on the term.
I think, Paul. Oh, sorry. Before you do that, there's some questions that might be relevant to. In the Q&A that could be relevant to the last slide. So I don't know if you want to address them.
All right. If you want to pick up on one of them, Robin, yeah, please do.
Oh, I was just going to, one of them was around, should there be only one term sheet across all investors for any given round? Typically you would have one term sheet, and that would be the term sheet that the lead would set. Even if the round was a co-lead situation, it's still only one term sheet. And then everybody in the syndicate will follow that.
Yeah. And then, another question is, is putting an implied valuation on a company similar to a price round? And the answer to that is no. So the way the convertible note works is, the investor at the time that the round converts will get the better of the two, right? So either they will get the kind of conversion at the kind of cap that you see on a convertible note, or a discount, right, to the actual pricing of the round. So the pricing of the round actually is deferred when you're issued a convertible note. So don't think that if you get $100 million valuation on a convertible note that your next round will certainly exceed that. It doesn't have to. And the investor is really capping themselves. So the convertible note actually protects the investor. So if the next round comes in at a $200 million valuation, the investor gets the better of the two, which is the lower valuation.
And Paul, as Aaron said, basically the conversion caps are really an incentive for the investor. It protects the investors, equity position down the road if the company has a tremendous rise in its value.
Yeah, absolutely. I mean, it's the cap on a convertible note or a safe is there to protect an earlier stage investor who comes in expecting that the company may be worth, $5-10 million, and then they don't do a priced round until it's $100 million valuation, and so they convert at $100 million and say, "Gee whiz, when I came in, the company was worth 5-10 million." So you put a cap, say, 10-15 million, whatever. So you protect the investor from a situation where the company ends up going much further before it actually has that priced round. Yeah, Alan, that's absolutely right. All right, let's go on to some term sheet fundamentals. Why are we doing a term sheet? What is the purpose? So the benefits are that basically it summarizes the deal terms, and to be frank, it makes sure there is in fact a deal. Unless you have a term sheet, sometimes you don't know if there's a meeting of the minds. And as lawyers, we find the term sheet important because we want to make sure that the parties have complete agreement before we put pen to paper. Otherwise, we'll write the documents one way, turns out there's not a deal, and we have to go back and rewrite it, and that just adds to costs. So generally, the term sheet provides a template to the lawyers in the drafting process and just structures the negotiations. Term sheets are not usually legally binding, except for certain provisions like confidentiality and no shop. But don't be fooled. If you sign a term sheet, even if it's a non-binding term sheet, it still has significant moral weight, as I would say. So many times I've had a client or a new client come to me with a term sheet. They say, "Well, I've signed it. You didn't have a chance to see it. I signed it, but don't worry, it's non-binding. We can change things if we like." It doesn't work that way. Generally speaking, once you've signed a term sheet, yeah, there's some ability to negotiate, but it becomes very difficult to claw back from positions you've agreed to in that term sheet. So don't go signing a term sheet unless it's something that you really feel pretty comfortable about everything that's in it, which comes to the next point, that you're strongly advised to consult with a lawyer at some point in the process, at least before you sign it. Speak with your lawyer to make sure that you know what's in there, you're comfortable with what's in there, you're not going to have regrets later. Generally, the first draft of the term sheet is presented by the investor, and that's when the negotiations begin. Aaron, any thoughts on that?
Yeah, I think that's a really good point. Robin brought this up earlier around speed. We're seeing things move faster than ever before. And I would, just caution founders to not to necessarily optimize for speed, but kind of optimize for partnership, optimize for investors who really want to get into business with you. And take your time. It's okay to be patient and take some time to evaluate the term sheets, to send them to your your legal counsel before you sign, to just make sure everything checks out. But a lot of what we're seeing right now is founders and investors are optimizing for speed and dilution, and kind of overlooking a lot of the nuances and idiosyncrasies that might show up in the term sheet.
Yeah, Aaron, thank you for that. Alan, any thoughts?
I like in any transaction, I would certainly spend the time up front negotiating, your term sheet. Because if you agree to all these points now, as you get to the point of the drafting the final documents, it's going to be a lot easier, and you'll probably save yourself some legal cost at the back end.
Agreed. Robin?
Yeah, I think like the process, what typically happens is like you have a verbal agreement with the lead investor, and then you get sent a term sheet. And like that document is a living document. And so you're not expected to sign immediately just because they send it to you. And so that's actually like the initial start of the conversation. And you actually will go back and forth on that before both parties sign. And then you go into drafting the documents and all the legal stuff. And so typically, I highly advise getting the lawyers in the room ASAP, because we've found even sometimes when you're scrambling to get a lawyer to put together a data room or even all the docs and the disclosure schedules, et cetera, it can delay the process a lot, especially if it was not clean in the past. And you want to have it closed, because then you don't want the term sheet to expire and renegotiate, stuff like that. And so I agree with everybody here, and just wanted to put that out there in terms of like what that process will look like if you've never gotten a term sheet before.
And Paul, it goes without saying, you want to hire an attorney who's done venture deals before and understands the nuances of these types of transactions. That's very critical.
Yeah, absolutely. I mean, you want a lawyer who's done the deals and who knows where the pressure points are. In any term sheet, there are things that are subject to negotiation and things that aren't. And if you've been through the process many, many times, and most VC lawyers, they represent companies, they represent investors. So they know the analysis, the thought process from both sides, and that gives them the ability to negotiate more effectively and to use the bargaining power to best advantage, to use your bargaining power where you may be able to get an important point, and not to waste your bargaining power on a point that you're probably going to lose. So anyway, those are good points, Alan. So let's go talk a little bit about current negotiating trends. We've touched on some of this, but I want to make sure we touch on all of it. So generally speaking, and as we've noted, deal terms are tending more founder friendly, which is obviously good news for the founders. Valuations are increasing. We've talked about that. Robin made a point when we were discussing yesterday about how there's almost a tendency in which companies are growing into their valuations, that a VC will agree to a valuation that isn't justified by where the company is today, but hopefully they'll be there in a few months from now. Increased competition for the best deals. I think the fear of missing out has been brought up already 2 or 3 times on this call. It is definitely a thing in the VC industry. I will say to you that, I mean, again, I represent investors, I represent companies. There's nothing to get the attention of an investor like the prospect that someone else will get their deal, that they'll lose their deal to another investor. So FOMO is certainly a factor in all of this. As we've noted, deals are getting negotiated faster and closed faster. As a result, diligence is often diminished or at least delayed. And when we say delayed, we mean perhaps delayed past the signing of the term sheet. And this was another point that Robin made yesterday, how that has the effect of increasing founder risk. Because if the diligence is done before the term sheet is signed, then the bad news comes out and it may be that there is no deal. There's no term sheet. You never get to drafting documents. But in an accelerated process, a term sheet is signed fast by an investor who wants to make sure they lock in their deal before some other investor gets it. And then they go and start doing their diligence. Well, at that point, by the time they realize that there may be bad news out there, the lawyers are already drafting documents. Costs are incurred. Time is spent by the founders on a process that may end up going south. So this is a way that the acceleration of the process can actually be a problem for the founders. Round sizes are increasing. And lastly, we're seeing more secondary offerings integrated with VC rounds, especially at the early stages. That's something that we've often seen in later stage, C round, D round. I'm doing a deal right now representing the company in a Series A round where earlier stage investors are taking money off the table. That's not something that would have typically happened in the past in a Series A round, but it's something that we're seeing more of now. And we can see how it's a way that the interests and expectations of the company on the one hand and the investors on the other hand are coming together, because you have a company that may only want to bring in $5 million, and you have an investor that wants to put in $7 to $10 million. Well, if there are founders, employees, earlier stage investors that would like to take some money off the table, that's how you bridge the gap between the company and the investors. So all in, it's a good time for founders who are seeking VC money. I'm sure you all are doing your best to take advantage of it. Robin, why don't we go with you?
Good time to be a founder. But I would say, especially around like the FOMO piece, I think, the genesis of that is like, I remember when we were like first started out in venture and we were underwriting deals and like looking back in those memos, and it was like the term unicorn was just coined back then, right? Like it wasn't even like a really big thing yet. And now you're seeing companies, even especially in New York, and why VCs are doubling down in New York is that there's like decacorns, right? Like nobody before would have thought that New York would produce like companies in tech that are like tens of billions of dollars, right? Like whether it's Datadog, it's Mongo, it's Peloton, and like the size of which like this piece of the pie has grown so much because like of the acceleration of offline to online and the digitization of the world. And so for investors in terms of FOMO, it's actually like if we can't get into the deal, it's almost impossible for us to get into the deal in the later rounds. Because when things are working, people just continually double down from the insider perspective, right? Why would I share ownership of a company with other investors when I know this is working? I'll double down and give better terms and more money into the company. And so like that's one piece of it. And so like if we don't get into like a really great company, the price of not getting in is more expensive than like doing too many deals at high valuations, because it's usually certain deals that run away, and those are the ones that matter. And so that's just like the trend that I've been seeing. Like we've never before have seen companies that could be this global, this big, this fast, and software has played such a big part of that. Now there's $100 billion companies, right? So it's very exciting.
Yes, it is. It's an exciting time. Aaron, your thoughts?
Yeah, there's a lot here. One, there's a term we use internally called price to perfection. And so we try to warn our founders not to kind of price their company too high, such that the goals and expectations of reaching the next round are, you have to do everything right to get there, right? We call that price to perfection. Otherwise, you'll have a hard time raising the next round, or it'll be a down round. So that's one thing I would encourage people to think about, is when you price your current round, make sure not to price it to perfection. everyone mentioned, Robin mentioned yesterday, around the current value of your company is actually a future value, right? And that's kind of how venture capital works. You're investing in a company right now because of its rate of growth, in the expectation that it can reach that future value. Don't make that bar too high that it's kind of unreachable. As far as unicorns and decacorns, I remember when that term came out, Aileen Lee, when she kind of coined it, it was kind of like a demarcation event in the venture capital industry, because for the first time, the expectations of venture capitalists were superimposed onto the founders in a very public way. So a decacorn and unicorn is important to VCs because it's the marker of whether or not investment can return your fund, or how much of your fund can it return. And it becomes a kind of major goal for venture capitalists in their portfolio construction. But when that term became very public, it has been superimposed on the founders. And now the founders are like, I want to be a unicorn, or I want to be a decacorn, versus more like, I want to build a great company that solves the problem, right? And I always want founders to not get too caught up with these terms that are very important to us as investors, where they should be really focused on, how do I build a category defining business? And if they do that, it will likely ascend to being a unicorn or a decacorn or $100 billion company. But it was when that term came into existence that we saw our expectations really superimposed on founders, and even in their language.
Really important points, Aaron. Thank you for that. Alan?
Paul, there's probably no better example of the phrase, growing into your valuation today than probably what's going on in the electric car industry. And, you think about, putting Tesla aside, you think about other companies that have recently gone public and probably have not even commercially sold their first vehicles yet. And they're getting valuations far in excess of traditional automobile companies that have been making their products for generations. And it's going to be interesting to see how those valuation estimates today actually, whether they come true down the road in 3 to 5 years. So it's an interesting time, and I think most people in the industry are probably struggling getting their hands around the level of valuation that we're all seeing today.
Agreed, Alan. I'd like to. This takes us to one of the questions I'd like to address. With record level of investments happening, does this mean we are at the top? Is this another bubble? And I think this is, it's a good time to be a founder, but people are also concerned, is the party about to be over?
Paul, let me just address that for a moment, because I think, and Robin, said it earlier, we're coming into a time where the way business is handled is being changed because of the ability to use technology and because of what COVID has created in our business environment. So I think you're seeing great technologies being developed because of the necessity for them. And you're also seeing a time where there's so much dry powder sitting on the sidelines that has to find a home. And that continues to drive valuation. So I think it's the perfect storm right now in terms of why the VC industry is performing the way it is. So I don't think we're approaching another bubble, to be quite honest with you. I'd like to hear what my other two co-panelists have to say about that.
Yeah. So I think there's a couple of different questions here. It's like, are you in a bubble, and are you at the top, right? Now, this idea of, are you at the top, and suggests that it's going to pop and it's going to be over. All right. So let's suppose we're at the top, right? If we're at the top of the bubble, and then tomorrow the bubble bursts, and then we get back on this call and you ask Robin and you ask me, are we surprised? We'll probably say, not surprised. The valuations are high. This company I just looked at yesterday was marked, 10 or 20 times higher than I had seen a similar company a couple years ago. If we suppose we're at the top and tomorrow it busts, and you ask us today, most investors would not be surprised. Because of that makes me believe we are in a bubble, right? But what is unknown is, are we at the top? Right. And that's not a question I'm capable of answering. I don't know how long the music keeps going. And so it could easily be multiple years. And I think earlier in this conversation, we were, I think it was Alan was showing, one of you, Alan or Paul, you were kind of showing the stats. And if you look at the amount of new capital entering the ecosystem, you described there was more new capital from funds than ever before. It might have been like 100 billion or something like that. That's new capital to be deployed. So because of these things, I can't figure out when we're going to be at the top. But I think it is quite obvious that prices are continuing to go up, and they're going up really rapidly. So that's kind of, I know I didn't really answer the question, but that is kind of my general sentiment of what's going on, if I'm being intellectually honest about what we're seeing.
Thank you, Aaron. Robin?
Yeah, I mean, I wish I had a crystal ball as well, so that we know how to plan. But like, so much of it is also dependent on like macro factors and what's happening in the public markets, right? And also like what's happening with inflation, like the volatility, like, you know, still like people are underwriting deal valuations to a potential outcome when you go public. And so I think that you will, like, if the market crashes, and I don't think it's going to like immediately, but like you will see some pullback. And also in terms of capital, like just because we have the capital doesn't mean we have to deploy it. Okay. So like, I think when there is that time where suddenly there is a sudden downturn, like we will hold off because a lot of our portfolio may need that capital themselves, and we would reserve it for them as opposed to like constantly deploy it on new deals. And so, you know, that's just like my 2 cents.
Yeah, I do believe whether or not we're in a bubble in the next 5 years or 10 years, when you look back at these vintages, the overall return of the asset class is not going to be as attractive for the average fund. Because the entry prices are coming in so much higher. If you don't have liquidity events, actual liquidity events, not valuations that are rising in a commensurate way, then the overall expected return of the asset class is going to go down. Now, there's still venture follows the power law distribution, both the companies we invest in, as well as our returns as well. So there will be a small number of winners. So a small number of funds that are in these very massive outcome type companies like Coinbase. And so they're going to kind of do well. But I believe there are going to be a lot of losers, and more so than we've seen in the past, because the entry prices are too high. Going back to this idea of pricing to perfection, I don't think you're going to see a lot of liquidity. Like when we first started, we had $20 million exits and $50 million exits that actually returned, a reasonable amount of money, because we entered these companies at single-digit valuations. Those are not the companies that returned our fund, but like those were companies that like actually contributed a little bit to our returns. In the future, that all goes away. And it's like, do you have a multiple fund returning company in your fund? And if you do, you can probably do well as a venture fund. If you do not, your performance is going to be horrific.
Because Paul, remember, venture capital is a game of thirds. A third of the deals they do, they lose 100% of their money. A third of the deals that they do return capital, and a third of the deals give the fund return that's necessary. I'm not sure if those statistics will change as a result of these high valuations, but that's sort of the business.
That's a good point. So that's a great point. A third of the companies will lose. They will go to zero. See that middle third? That's going to go to zero too, because the entry prices on average are going up. If it sustains itself, it keeps moving in this way, that second third you're talking about goes away. And in reality, because it follows the power of law, it's not a third of the companies that return the fund. It's like 2 or 3 companies. It's like single digit percentage that actually drive meaningful return. And so if you can still pull that off, you still win as a venture fund. But a bunch of the average funds, because that second third, that middle third, well, that can go away because the prices are so high. Because Autodesk is not going to just acqui-hire a company for $150 million, right? That's not going to happen. Like that's from a corporate development standpoint, they're not going to play that game. And so it means that these companies that are pricing too high are going to, those exits will go away. They will be grouped into the 0 category.
All right. So this is a fascinating conversation, which I'm sorry to have to cut short. We have a couple of minutes left. Why don't you each take 30 seconds with sort of closing thoughts for founders who are looking to raise money in this market? Robin, why don't we start with you?
If you're thinking about fundraising now, just be mindful around like holidays and like timeline to close. And also a lot of funds probably are like, oh, we're done for the year just because of how much capital has already been deployed. So just something to bear in mind. Go out like fresh, hit your numbers and go out fresh in the new year might be like a really good way to start.
Thank you. Alan?
I think it's been said, but I'll just make one final comment. It's a great time to be a founder, and you still have to knock on a lot of doors to raise your capital, but there certainly is, for a good business, a good idea, there certainly is capital out there to support you now and in the future.
Thank you. Aaron, final thoughts?
Yeah, I know I said a lot about pricing to perfection and like this, we might be in a bubble, but I agree that it is a good time to be a founder, and you are able to raise larger rounds than before. And what I'm most excited about, a trend that I'm seeing now that was different 7 years ago, is you can raise enough capital to then put your head down and work really for a year or 18 months. Because you can raise a $3 million, or I've seen $7 million seed rounds. And so that's good for founders, right? Because you can actually have the space to fail and try again and iterate without having to kind of constantly go back to market. So I am excited about founders and their ability to have capital to compete and experiment.
Thank you for that, Aaron. And thanks to the entire panel. This has really been a great conversation. And thank you for the attendees. I'm sorry we didn't get to everyone's questions. There was some tension as to, do we do questions or do we get to all these important topics? But as I noted, a couple of us are having office hours. If you look in the chat, you'll see my Calendly link. Feel free to go and set up a time. I'm happy to speak with people one-on-one. Alan Wink has his email address there as well. He's would like to, happy to set up time to talk to people. We also have contact information there for Robin and for Aaron. Aaron mentioned that he, feel free to reach out to him. He'd be happy to connect with people to the extent possible. With that, we will thank you all again for attending. We will be sending around the video and the slide deck, so keep an eye open for that. And you feel free to distribute it to your friends, contacts, colleagues, and do pay attention to the Tech Alliance emails for future events. Again, thank you, Robin, Alan, Aaron, great panel. Have a good afternoon.
Thank you.
Thank you.
Bye, everyone.